Hey everyone, and welcome to today's Explainer. I am absolutely thrilled to have you here because today we're breaking down a seriously fascinating market phenomenon. Okay, let's just dive right into it. If you've been following the markets for any amount of time, you already know that expiry days, well, they can be incredibly volatile. But have you ever really noticed those absolute explosions that happen in just the final 90 minutes of an expiry day? Whether it's Sensex, Nifty, or Bank Nifty, that last hour and a half can produce violently huge market moves. Today, we're going to look at the exact strategy and the underlying math to capture these explosive moves.
To really grasp the scale of what we're talking about here, let's look at a real-world example from our source material. On a recent Sensex expiry day, right around, say, 2:55 p.m., a put option premium experienced an absolute blast. The price jumped from just 30 rupees all the way up to 160. That is a return that multiplies your base by more than 5 times. I mean, think about it. A 5x return on a single trade.
But wait, what's truly mind-bending here is the time frame. That massive jump from 30 to 160, it didn't happen over a week, or a day, or even an hour. It happened within 10 minutes. Yeah, no joke, 10 minutes. Within that tiny window, the price yielded a return of more than 5 times the initial premium. It's exactly this sheer velocity that makes this setup so uniquely powerful. And honestly, it demands our focused attention.
So, how is this actually possible? Well, here is our roadmap for today. Number 1, the big blast on expiry day. 2, the real math of gamma blast. 3, normal day versus expiry day. 4, identifying the right time. And finally, number 5, a foolproof strategy for trade entry.
All right, let's kick things off with Section 1, the big blast on expiry day.
So, the secret behind these massive, violent upward spikes in an options premium price is something called a gamma blast. Basically, as you get closer to the final hours of an expiry day, the gamma of an option peaks. But what does that actually mean in plain English? It means the option becomes hypersensitive. When gamma is peaking, even a tiny, seemingly insignificant movement in the underlying index acts as a huge catalyst. It essentially multiplies the effect. A small ripple in the index creates a literal tsunami in the option price. But, to truly trust any strategy, you have to understand the logic beneath it. Which brings us to Section 2, the real math of gamma blast.
Now, I want to pose a critical question to you that gets right to the heart of this explainer. Think about this little puzzle. Why does a 50-point move in the index yield a 25% return on a regular Wednesday, but that exact same 50-point index move can yield nearly a 90% return on an expiry day? Same index, same movement size, radically different results. To answer that, we really need to do a direct comparison. Let's look at exactly that in Section 3, normal day versus expiry day.
Okay, this brilliantly illustrates the underlying mechanics, so let's walk through it carefully. Imagine it's a Wednesday, just a normal, non-expiry day. A standard at-the-money option might cost you 100 rupees. It has a delta of 0.5. If the index moves up 50 points, you multiply that by the 0.5 delta, which means your option premium increases by 25 points. So your 100 rupee option becomes 125. A solid 25% return, right? Now fast forward to expiry day, after 2 p.m. Because of theta decay, the time value eroding, that exact same at-the-money option is no longer 100. It's heavily discounted, sitting all the way down at just 30 rupees. If the index makes that exact same 50-point move, the delta is still 0.5, so the option still moves up by 25 points. But here is where the magic happens. Adding 25 points to a base of 30 pushes the premium to 55. You've almost doubled your money. That's an 83 to 90% return. It's the exact same point move, but because the base premium is so cheap, the percentage jump is just astronomical. Now, understanding the math is great, but how do we actually spot this in the real world?
That leads us to Section 4, identifying the right time.
Execution here requires strict discipline. Here are your exact prerequisites. Step 1, do not act until exactly 2 p.m. on expiry day. Step 2, open your out-of-the-money, or OTM, call and put charts. We don't want in the money, we don't want at the money, we want strictly OTM. Step 3, look for very specific price targets. For Nifty, look for options priced between 10 and 15 rupees. For Sensex, look for options priced around 25 to 30 rupees. Essentially, you're hunting for these specific, cheap premiums that are just primed to explode. Once you have your charts open, you're watching for one specific pattern, a change of character, or CHOT for short. On an expiry day, because of that theta decay we talked about, an option is naturally in a state of free fall. It's dropping, constantly making lower highs and lower lows. The change of character is the exact moment that falling option breaks its downward pattern by violently surging past a previous swing high. It's the very first massive clue that a reversal and a blast are imminent. Let's break down the sequence of this pattern so you don't get trapped by false signals because nobody wants that. First, the option must be naturally falling due to theta decay. You are watching a falling knife, so you got to be cautious. Second, it must establish a confirmed lower low. You absolutely cannot have a change of character if there isn't a prior downward structure to break. Finally, once that true lower low is locked in, the moment the price breaks above the previous high, it signals an immediate reversal. The structure is broken, the character has changed, and the blast sequence has initiated. Okay, so you've spotted the change of character. How do you actually execute the trade? Let's cover that in our final part, Section 5, Foolproof Strategy for Trade Entry. So you basically have two execution styles here. The aggressive entry means you buy immediately at the breakout of the very first swing high. You're trying to catch the absolute bottom. But our source material strongly prefers the safe entry. With this approach, you wait for the breakout of the second, or previous swing high. You place your entry order about 1.5 points above that second swing high, basically acting as a buffer. Why? Well, because waiting for that next swing high provides much higher conviction. It filters out those annoying false signals and confirms that the momentum is actually real. The really crucial point here is that you do not need to catch the absolute bottom to make massive returns. Remember our very first example. In that scenario, the trader didn't catch the move at 26 or 30 rupees. By waiting for the safer second swing high confirmation, the entry triggered at 57. And from that safe 57 rupee entry, the price still blasted all the way up to 160. Waiting for confirmation still allows you to ride the massive wave created by the gamma blast. Before we wrap up, it's totally vital to remember the standard disclaimer derived from our source: investments and securities markets are subject to market risk. Always read all related documents carefully before investing. These are highly volatile setups, and discipline is absolutely non-negotiable. So, as we conclude today's explainer, I want to leave you with this provocative thought. Now that you actually understand the hidden math of the gamma blast and the exact structure of a change of character, how are you going to apply this discipline framework to cut through the noise during the final 90 minutes of your next expiry day? Thanks so much for exploring this explainer with us today. Stay focused out there, and we'll see you next time.